Welcome to Trading Hour. I am Reema Tendulkar. With me is Sumaya Abdi, and sharp, big gains for our markets right now. We're currently up close to about 2% on the benchmark indices, following the big rally that we had in U.S. markets overnight, and global markets in Asia too are following suit. There is green across the street. And one of the key important updates that we got from Asia this morning is Reserve Bank of Australia's interest rate decision. Contrary to expectations of a 50 basis points rate hike, RBA, Reserve Bank of Australia, has gone for a 25 basis points rate hike. This is the first soft pivot from a major central bank. So perhaps they are waiting to see the impact of the already taken interest rate hikes on the economy to see if inflation tames down before they raise further rates, before they front load even more. So this is an important update. The rest of the global markets are holding up pretty well. Nikkei is up 2% in the last two trading sessions. It was up about 1.5% yesterday. It's followed it up with a 2.5% gain. China and the Hong Kong markets are shut today. Korean markets have opened with strength after the long weekend holiday. They were shut yesterday, but this morning the Korean markets are higher as well. For our own markets, you can see big moves coming through in the banking names. The Nifty banking index is up close to about 2.5%. You've got strength in the IT names ahead of a barrage of earnings which come through next week. So next week we've got earnings from TCS, Wipro, Infosys, as well as HCL Tech. So all the large four IT companies will be reporting numbers next week. And following the rebound that we had in Nasdaq, the IT stocks too have opened with considerable strength. The Nifty IT index is showing you a gain of close to about 2.5%. Hi.
Hi, Reema. Morning. So let's get started and tell you all that we have for you today. While indices build on gains after a gap-up opening on the back of strong global handover, Nifty Bank outperforms. Mid-caps lag, though. We'll be joined by Siddharth Khemka of Motilal Oswal Financial Services to talk about the fundamentals and the market outlook. We'll keep high investment weightage in India. That's the word coming in from veteran investor Mark Mobius. We'll get you excerpts from our exclusive chat with him in just a short while. As the insurance regulator gets set to roll out Bima Sugama, one-stop shop for all life and general insurance policies, we get you an explainer on this Amazon-like platform and how it's going to work. We'll also bring you stock-specific action, news flows drive moves in Avenue Supermart, Marico, M&M Financial and Vedanta. A little bit later on the show, we'll also bring you up to speed on all the details. And amidst the turbulence in the currency markets, we'll focus on companies with a higher Forex exposure. More details on that as well a little later. All that and much more lined up over the next 60 minutes.
And as promised, let's focus on the markets and get you some expert opinion now. Veteran investor and founder of Mobius Capital Partners, Mark Mobius, spoke to us exclusively and discussed the global markets, sectors that he's betting on, the Credit Suisse turmoil, and much more. Listen in to that conversation.
Regarding the U.S., I've been saying for quite some time now, the Fed is going to continue raising rates. And that, of course, is putting a damper on the market. People must remember that the playbook for central banks around the world, particularly the Fed, is that they want to raise interest rates above the inflation rate. Now, the inflation rate that they use, of course, is the CPI, the Consumer Price Index, which now stands at about 8%. That means interest rates have to go to 9%, of course, if the CPI stays at this level. So I think more is in store for the markets. And as you know, for the S&P 500, we're right at the support level. If it breaks below the support level, then we're going to see more blood on the streets. The interesting thing is that India is really bucking this trend. It's amazing what the Indian market has done. And it speaks very well for the policies that the government has pursued, and the general buoyancy of the Indian market is very good.
Are you buying now in India? Because we have seen a clear shift. IT, which was leading the rally for 3 years, has taken a big backseat while banks have started to outperform.
Well, we're looking at both software, persistent systems, for example, would be one. And we're looking at infrastructure-related stocks like Apollo 2. So these are the kind of stocks we're looking at. And we think those are the stocks that will perform very well going forward.
Hi, Mr. Mobius. In the past as well, you've been bullish on both those two names. But, in terms of approaching equities globally, I think Taiwan was one of the highest allocations, India and then China. How have things changed for India? Have you increased weightage in the last few months? If you could give us a broad number out there. And also, is India now top of the pack?
Well, I think India is really beginning to take more and more manufacturing share from China. And I think the government policy, the so-called Gati Shakti policy, speeding up the bureaucracy is going to be very, very good for India. You're going to see more and more companies moving manufacturing to India. And as you know, Apple has moved its latest iPhone manufacturing to India as well. So I think these are very good signs going forward. So we're going to be on the lookout for companies that manufacture this kind of equipment, and also companies that are going to contribute more and more on the software side.
Weightage on India has increased, though, Mr. Mobis, in the last few months, since things are looking, on the policy front, the economy as well has recovered quite a bit. Have you increased weightage to India? And what's the pecking order now? Taiwan used to be number one, I think, in terms of exposure. Has India overtaken Taiwan now?
No, not yet. We, of course, continue to look at India for possibilities of additions. But as you know, in our portfolios, we move very, very slowly. When we have a stock that we think is going to be good, we hang on to it. And that's the reason why, for example, the stocks that we have in India, we haven't sold. We continue to hold them. And the same thing is true in Taiwan, although in Taiwan, the weighting has been pretty high. So we want to reduce that by either decreasing Taiwan or increasing other countries like India.
Mark, you'd given us this thesis, and we kind of explored that in some detail about emerging markets generally doing very well, and foreign outflows out of India because of that, not country specific. And how there were some global funds now who were launching mandates ex-China, etc. Are you still seeing that? That is one. And second, later this month, in the middle of the month, we have that big party conference in China. Many are expecting that, once that is done, they will kind of completely dramatically change their policies in terms of zero COVID and attitude towards businesses, the crackdown there, etc. So there will be a big shift post that. Would you agree with that? Go on.
No, I don't think the policy mandates in China will change very quickly, particularly if she is re-elected and becomes the paramount leader again. So I don't think there's going to be a big shift. However, the Chinese are well aware that they need to have more dollars flowing into the economy. They need more funds to support the economy. So they will do their best to attract foreign investors, but within reason. The problem is for them is the reluctance of many investors to go back into China. I mean, we've been in client meetings where we say, well, we want to talk about emerging markets. And immediately the clients say, we don't want to talk about China, talk about anything else except China. So a lot of people have been burned in China, which means that India is in a pretty good position. Of course, the problem with India is that up to now, they've been rather restrictive and the market is rather smaller, less liquid. But the interesting thing is that if India is added to the various bond indices, emerging market bond indices, that could mean more and more flows into the Indian bond market. And of course, that could be accompanied by more flows into the equity market as well.
Okay, Mark, the other issue which is dominating headlines, or at least financial headlines, is what's happening in Europe with Credit Suisse and even with, DB perhaps. Do you reckon this could snowball into another Lehman, or do you think it's much smaller?
That's quite a surprise. And the fact that, you have a bank like Credit Suisse in the news is regarding that. But what it does is it begins to have people start thinking about emerging markets and thinking, wait a minute, emerging markets have been considered very risky and so forth. But how about these big banks in Europe and America? What's the situation there? So in some ways, it's quite favorable for emerging markets and for India, where people begin to think, well, maybe we should diversify a little bit away from Europe and away from the US.
All right, with that, a very quick break. Up next, we'll talk about what's buzzing in the commodity space. Joining in. Hi, welcome back. You're watching Trading Hour. Over to Manisha now, who joins in to talk about all that's happening in the commodity corner. And today, the focus is on metals. Hi, Manisha.
Thank you for that, Sumaira. Well, I'm looking particularly at precious metals because we have seen a very smart rebound overnight. I remember last week it was a sell call, short maybe this festival season on gold. But all of those headlines seems to have turned around because we've seen 8% of a gain in silver overnight. Gold was up 2%, platinum was up 5%. And this is because of the US dollar and the treasury seeing a decline. The UN calling for central banks to go slow on their aggressive rate hikes is the news that really made all the difference here. And then you also had the US manufacturing data that shows the lowest expansion in last 2 years. All the other economic data that came in from US, Japan, UK and European Union also were on the weaker side, and that led to some safe haven buying in precious metals also. And then it is a slew of Fed policymakers making statements this week. That is what the markets will watch out for. You also have the US non-farm payroll data coming in on Friday. That would give you a further direction as well. But at this point in time, it's a 2-month highs that we are trading on in sense of gold and a 3-month highs for silver as well. Markets do believe that from here on, because we're looking smarter on charts now at around $1,700 per ounce, the rest of the week could also see some more buying coming in. The whole difference really is between where the gold is trading in dollar terms and rupee. Because of the rupee depreciation, there are better investment returns that Indian investors clearly have seen. So when you look at YTD gold in dollar terms, we have seen a decline of 7%, but in Indian terms, a 4% of a jump up is what you've seen in investment. Same is the case with silver, a decline of 11% in dollar terms, but we are down just about 2% when you look at the rupee terms there.
Thank you very much, Manisha, for that. Let's move on now. The insurance sector is preparing itself for what could be the biggest reform in days to come. The insurance regulator is set to operationalize Bima Sugam. Yash Jain is joining in to tell us all about this and how it will work. Yash?
The two-letter word Bima Sugam could actually prove to be the biggest reform in the insurance sector in the days to come. The insurance regulator has asked insurance companies to operationalize Bima Sugam by January 2023. But what is Bima Sugam? Think of it as an Amazon-like platform where all life and general insurance policies will be listed. Bima Sugam will be responsible for sale, servicing and claims coming from these insurance policies. Who can buy insurance policies from Bima Sugam? Aggregators like Policy Bazaar, brokers, banks, insurance agents act as facilitators or bridge in terms of selling insurance policies through Bima Sugam to individuals. What's the best part? You as an individual can also buy your life, motor or health insurance policy through Bima Sugam. Now, who gets the funds to start Bima Sugam and who owns this platform? Bima Sugam will need approximately 85 crore rupees as initial capital. Insurance companies are expected to be major shareholders of this insurance platform. So initially, some general insurance companies will hold about 30% stake in Bima Sugam and another 30% will be held by some life insurance companies. A list of some of these general and life insurance companies you'd be able to see on your screen. Now, as more funds are required for the operations of Bima Sugam, more insurance companies will be roped in as investors. Now, the most important part, what's in it for you, me, and many other policyholders? Bima Sugam is expected to significantly reduce commission paid by insurance companies. How? Let's look at life insurance sector. Life insurance companies pay around 21 to 45% commission on the sale of their policies depending on the policy term. Assuming that an individual buys a 10-year insurance saving policy, if the premium charged on this policy is about 100 rupees, then the commission included in this 100 rupees would be around 30 rupees, which would be paid by the life insurance company to the insurance agent, aggregator or the broker. This would leave the life insurance company with just 70 rupees to invest and give returns to the policyholder as his policy matures. Now, the commission on Bima Sugam could come down to just about 5% as compared to the earlier 30%, leaving the insurance company with much larger sum to invest on behalf of the policyholder. On a term insurance policy, with the same calculation, straight discount could be given on the premium to the same policyholder. Now let's look at the general insurance space. If on a motor or a health insurance policy, a general insurance company pays a total commission of 19%, Bima Sugam could bring down that commission to just about 5%. What could that look like? If the motor or the health insurance policy through an agent, broker or an aggregator comes to a premium of about 100 rupees, then the same policy through Bima Sugam would actually come to you at a premium of just about 85 rupees.
Yash, thank you very much for so comprehensively explaining that. Need to get into a break. When we return, we'll discuss market technicals. Jay Thakkar of Marwadi Shares and Finance joins in next. Welcome back. The gains are intact. We're still up 1.9% on the benchmark indices, but a whole host of quarterly updates have started trickling in. So let me welcome all my colleagues in. Mangalam is here first, standing by to tell us more about the FMCG space and what Marico as well as DMart had to tell us.
But as far as Marico is concerned, it's a muted quarter for them, and that's exactly what we saw in the way the stock is reacting as well. There are a couple of reasons why the quarter has been muted. The first one, of course, is that the India business has shown low double-digit sort of volume growth. The street was expecting that, nothing too much, but most of the recovery hopes were pinned in the second half itself. Secondly, as a result of that, the consolidated revenue has grown in low single digits as well for both India volume as well as the consolidated revenue growth. However, the problem is that the company, because of lower prices of edible oils, have passed the entire price benefits to the consumer while they were sitting on high cost inventory. As a result of which, quarter-on-quarter gross margins have actually compressed. So a margin expansion is only likely in the second half, and that's what the street believes now. But despite that, they have to spend on advertisements, etc., as a result of which, despite a rise in margins year on year, the EBITDA margins are the same. And to add to that, because of higher effective tax rate, the net profit will be lower as compared to last year as well. So these things make the growth for Marico, despite being in line, rather muted, and we are seeing a decline in the stock price. As far as DMart is concerned, very strong revenue growth coming in for them, 35% year on year, 6% quarter on quarter, and for the first time ever crossing that 10,000 crore mark on the top line on a standalone basis. Importantly, they've added 8 stores in this quarter, 10 stores in the previous quarter. That makes it 18 in this year so far, on track to analyst estimates of around 40 to 50 stores being added every year. And importantly, in the last 3 years itself, they've added 118 stores, which will now start contributing to growth. So those are a couple of factors which is keeping DMart afloat in trade today.
Mangalam, thanks very much for that. Also, Vedanta is making news. They've released their Q2 update, and Nigel has all the trends that have come through. Nigel.
Well, on Vedanta, a couple of global tailwinds as well are playing out because the dollar index has cooled off and the bond yields did cool off. So that's normally very positive for commodities on the whole. And in terms of their operational update, well, it's pretty much good actually. More positive than negative is what we saw out there. Let's start off with the largest part of their business. That's the aluminium business. Out there, you had a growth of close to around 2%. But the Jharsuguda facility, which is bulk of their production, that was up by close to around 5%, coming at around 440,000 tons. So that goes down as a positive. Zinc India business, that's predominantly Hindustan Zinc's business. Out there, you had the lead as well as the zinc sales. That's the integrated saleable metal, which jumped up by close to around 18%. Split up between zinc was up around 16%, lead was up by more than 20%. Also, the saleable silver production was up by close to around 28%. So that explains why that was a good performance coming in. For otherwise the largest contributor, now aluminium contributes more than that. The power sales as well have been moving up steadily, and in the past quarter it was up by close to 24% on a year-on-year basis. Bulk of that came in from TSPL, which was up close to around 50% on a year-on-year basis. So good going out there. Zinc International business, well, that's a smaller component of their business, but that as well is showing good traction. This as the Gamesburg mine is ramping up nicely. So out there you had a growth of close to around 35%. The only sore point is oil and gas, but the street is pretty much factored in that's not able to ramp up out there. So that was a little bit lower. So that explains why the stock is higher. Favorable tailwinds and a good operational update. Back to you.
Thank you very much for that. Let's move on to the BFSI space. Abhishek joins us to get us speed with the business updates coming through from IndusInd Bank, M&M Financial, HDFC Limited, as well as HDFC Bank.
Well, to begin with, IndusInd Bank has given the business update wherein they have gained market share in the loan book. So sequentially, that is quarter on quarter, deposit growth is perhaps the best in 5 quarters and loan growth is the best in last 4 quarters. So deposit growth is of 14.7% YOY and about 4.2% sequentially, while the loan growth is at 17.6% YOY and about 4.7% sequentially. For the first time, M&M Finance has given a number on their asset quality in the business update. So the gross NPA over there has improved to 7% when compared to 8% in the previous quarter. Disbursements remain strong. For the month of September, it was close to 4,100 crore, which is up about more than 9% on a month-on-month basis. The collection efficiency has improved 98% for the month of September when compared to 96% in August and 96% in June. HDFC Limited, the loans assigned is up 28% YOY but down about 4% sequentially. The dividend income was strong, up about 16% YOY and 98% quarter-on-quarter, while the individual loans sold is up 27% YOY and about 6.2% sequentially. On HDFC Bank, the loan growth has surprised positively, perhaps the best loan growth in 14 quarters on a YOY basis. So deposits are up 19% YOY and about 4.3% sequentially. The loan growth is at 23.5% YOY and more than 6% quarter-on-quarter. X of the pool that they have with HDFC Limited, the loan growth remains strong at 23.4% YOY and about 6.2% sequentially. The CD ratio has also improved, which indicates that the net interest margin may remain healthy. Back to you.
Abhishek, thanks very much for joining in with all those details. Let's invite Jay Thakkar of Marwari Shares and Finance, who joins in now for a quick tech check on the market. Hi, Jay. Morning. Things are looking up for today. So what is the trade on the index?
Hi, very good morning to you. And as anticipated, the bounce back has come on the indices, both on Nifty, Bank Nifty. And along with that, I would also take this opportunity to wish you, the entire team of CNBC TV18 and all the viewers of CNBC TV18 on my and my company's behalf, a very happy Mahanavami and Dashera. And I hope that, the wealth and the portfolio prospers from here on. I have, a positive bias on Nifty, Bank Nifty both, at least for the short term. I believe that 17,300 is quite likely on Nifty, and on the Bank Nifty, I'm eyeing the levels of around, on the upside, around 39,424 to 39,768. So if you can just round it off to 39,500 to 39,800 levels can be seen on Bank Nifty as well. So this bounce is yet to stay for a couple of trading sessions, at least till these levels are achieved. And thereafter, we can review further whether it continues or it reverses. But at least for the short term, I believe this bounce is likely to stay. And I have two buy recommendations. The first is from the banking pack, since I have a positive view on Bank Nifty. So one can buy Axis Bank at the current market price of 741, 738, that's the spot level. One can buy this placing a stop loss below 725 and targeting around 755 to 770. The bank has fallen quite much, in an impulsive way, and at least 38 to 50% retracement of the same can't be ruled out. The second buy recommendation is from the IT pack. Now that looks quite oversold to me, and I believe that from here on we can see some good momentum coming back into the IT space as well. And I've got a buy recommendation on Mindtree. The stock is trading around the levels of 32.13 right now. One can buy this targeting the levels of 32.70 to 33.20. These will be two short-term targets, and one can place a stop loss below the levels of 31.55.
Jay, thank you very much for joining in. Slip into a break. Up next, we'll discuss market fundamentals. Siddharth Khemka of Motilal Oswal Financial Services joins in next. The global rally is keeping our markets higher. We're up 2%. The Nifty is well over that 17,200 mark. Mid-caps moving in step. Very, very strong advanced decline ratio of about 7 stocks in the green for 1 in the red. Siddharth Khemka, Motilal Oswal Financial Services, also joins us on the show now. Siddharth, morning, and thanks so much for joining in. Wanted to get your thoughts in on two sectors. One is banks and the other one is the FMCG sector. We've seen the Q2 business updates trickling in from many of these stocks. So in the banking side, HDFC Limited, HDFC Bank, Innocent Bank, have come out with their business updates yesterday with CSB Bank also talking about, how the quarter is going to shape up. What have you made of that? And what does it tell you about how this earnings season is going to be for the banking sector? And secondly, Marico's business update appears to be a bit muted. So what does this tell us? What are the implications for the FMCG sector's earnings?
Yeah, very good morning, and wish you and all the viewers a very happy Dashera in advance. So if you look at the quarterly setup, I think banking is something which has been consistently now reporting strong numbers quarter after quarter, and the same is the expectation for Q2 as well. The pre-quarterly updates for some of the banks, NBFCs have started coming in, which only indicates the strong growth in the credit offtake. So the loan book growth is pretty good that is expected. The asset quality has already, we have seen the asset quality cycle going through the bad patch, and then all the banks and NBFCs providing for bulk of the bad assets. And from now on, here we are seeing the healthy recovery in the asset quality as well. So I think overall, if you look at the setup, the business is being driven across segments, be it the corporate, be it the SMEs, the retail segment, and some of the pressures that we saw some time back, especially in the retail segment, that is now again kind of improving with the strong demand in the festive season, and the kind of capex announcements by a lot of the corporates. I think the overall banking sector looks good. The larger banks focused, having a much diversified book and also focused towards the large corporates, would be the ones which will show a higher growth. So be it the ICICI Bank or the SBIs of the world, they would be the direct beneficiaries of this credit growth in the system.
Okay, hi Siddharth, morning. One of your picks that you're betting on is Bharti Airtel. But, you know, the stock has hit a 52-week high just yesterday. What is the upside that you see here now on the back of the 5G rollout?
Yeah, Sumaira. So if you look at Bharti, we have been witnessing continuous improvement in the profitability, and also the company has been showing sharp improvement in the ARPUs despite taking very few, you can say, price hikes. And that is mainly because of people uptrending towards the 4G services. And now with the 5G rollout, the biggest concern was the capex that would go around implementing of the 5G. Now that concern is abated a lot. The company has already launched 5G services in key 8 circles, and the management has said that they are looking to roll out 5G across pan-India by March 2024. If you look at the overall financials, they continue to remain healthy. We see consistent 20% growth opportunity. The 5G capex concern has abated. The company has been generating a lot of cash flows, is the best positioned to benefit from the improving ARPUs, which will now be also aided because of the 5G rollout. So overall, our target is about 910. Which gives an upside of about 11-12%. But I think with the rollout and the progress in 5G, we could see further upside as well on the stock.
Okay, so 910 is the target price on Bharti Airtel. Siddharth, real estate stocks have been on an upswing. In that, you're betting on Mahindra Lifespaces. Can you tell us why you prefer this stock over the others?
So, Rima, if you look at, we have been positive on the entire real estate pack, and we initially started with coverage with the Mumbai-focused players, where we like Oberoi and Lodha, which is the macro tech developers, and then we started covering some of the south-based players, which also looks kind of a better place. So these are the two regions where we believe the Bangalore and Mumbai related regions. These are the two regions which we believe that the demand-supply environment is constructive. And in that, we have recently initiated coverage on Mahindra Life. If you look at the overall Mahindra group, they have seen the kind of change in the management, the change in strategy, helping a lot of these group companies. And that same change is now, aggression is also visible in Mahindra Life. After several years of stagnant growth, we are now seeing that the pre-sales growth, the management is targeting almost 2.5x increase from about 700-800 crores of pre-sales to 2,500 crores of pre-sales annually, which is achievable in the next 2-3 years. They have added newer projects. The pipeline has improved. And we believe that the overall industry tailwinds, especially for the Mumbai and Pune, where this company is mainly focused on, will help shift towards branded developers. And hence, we believe that Mahindra Life is geared to benefit from this growth potential, especially given the change in the management as well as change in the strategy. So there we have a one-year target of 550.
Okay. It's not, but overall, do you see incremental bouts of volatility now? I mean, what is the outlook from here? What is your house view?
So if you're asking about the overall market, yes, there are several global headwinds which would increase the volatility, as we saw what happened on Monday, and then so Friday we had a sharp uptake, then Monday we had a fall, and now today again because of global uptick swings. So these things will keep on happening because of several global factors, be it the interest rate hikes, the inflationary concerns, the recessionary fears, and then you have the dollar index, the crude price. So I think in that environment, India looks pretty steady or stable. The domestic macros are pretty stable. India's GDP growth, you see the GST collection, advanced tax collection, manufacturing PMI, all looks pretty stable in this global environment. FIs have again become net sellers. That again because of what is happening with the US interest rates, where the risk of mode comes down intermittently and can lead to a volatility. And if you look at what is happening in India, the valuations had reached long-term average or marginally above long-term average at about 19 times on Nifty. So any correction definitely gives a good opportunity for investors to get into those stocks. We saw healthy profit booking in some of the consumption-driven stocks yesterday, be it the retail stocks, auto stocks, after declaring such good numbers. So I think that would be a good opportunity for people to look into their favorite stocks and get in those days of volatility and correction.
Thank you very much, Siddharth, for joining in, and season's greetings to you as well. It's time for us to slip into a very short break, but when we return, amid the turbulence in the currency market, we get you a special explainer on companies with a higher Forex exposure.
Hi, welcome back here with Trading Hour. Now, the currency markets have been in turmoil with the US dollar's sharp rise and a weakening rupee, and this affects companies which have a higher Forex exposure. Sonal Bhutra is standing by the big wall to tell us about all of these companies and their exposure. Hi, Sonal.
Thanks a lot for that. Well, the weakness in rupees, all one can talk about, right? And it has broken previous records. That is something that happened last week. So my colleague Yusuf and I thought, let's look at some data to focus on which companies have a higher Forex exposure. So 71 companies from the BSE 500, and this excludes banks and financials, have a foreign currency exposure of 3.5 lakh crore rupees. They have aggregate borrowings of 15.2 lakh crore rupees, out of which 23% is foreign currency loan. This is as per data from ACE Equities. And sectors which have the highest foreign loan exposure are chemicals, refineries and healthcare as well. So breaking it down to individual companies now. The one with highest percentage of exposure to foreign debt. Alkyl Amines, small loan amount 23 crore rupees, but 100% of it is in foreign currency. Glenmark Pharma with almost 90% of debt in Forex. We have Shipping Corporation at 100% of the debt from there. Oil India at 85%. There's Adani Ports, which has 66% of foreign loans. UP at 61.5%. There's Polyplex at 58%. SGVN at 55%. ONGC at 53%, to name a few out of the entire list. So it will, of course, lead to higher interest outgo in case of dollar-denominated loans and also higher expenditure, so to say. Important to note, the breakup of the Forex loan in a specific currency is not available to us. But some examples also that I wanted to point out of this lot. A lot of these companies have substantial export revenues as well, thereby negating the impact of higher interest outflow due to dollar strengthening, because earnings for them also will be higher, right? Now, the revenues in export markets could be a lot more for these companies, and of course, it not necessarily denominated in dollar. Alkyl Amines has Forex exposure of 23 crore rupees in terms of debt, but they have 270 crore worth of export revenue. UPL has 16,000 crore debt in foreign currency, but at 36,000 crore rupees revenues coming in from exports, out of which 7% is from Europe and 37% is from North America. So that's a big amount. Glenmark Pharma has 3,300 crore of debt that is in foreign currency, but 6,700 crore of revenues coming in from exports. And Sudarshan Chemicals has exports to 80 plus countries. It has almost 1,000 crore of revenue coming in from exports versus a 480 crore rupees of foreign debt. Additionally, as per Bloomberg, nearly $11 billion worth of foreign currency notes are getting matured over the next 1 year, while bonds worth $500 million each are maturing in October for NTPC and BPCL. Next year would see bonds of similar values getting matured for Vedanta Resources, there's IOCL, ONGC Videsh, and some of the other companies on screen. Now, when we are talking about loans, let me focus on revenue exposure as well for more names, especially in the specialty chemical space, because a lot of them have high amount of exposure. Many of the companies have huge exposure to exports because India's exports in terms of chemicals hit a record high at $29 billion. That is in FY22. It is up from $14 billion in FY14 itself. We have names like Vinity Organics with 69% exposure, Clean Science at 70%. There is Galaxy Surfactants with 62% revenues coming in just from exports. For fine organic, Naveen Fluorine, Atul Limited, NoSil, Aarti Industries, Deepak Nitrite and Alkyl Amines, the exposure is anywhere between 17 to 70% in the list that I have mentioned. And out of this, for some companies, we know the exposure to Europe as well. And that is where we are seeing crisis due to energy prices. And this is something that could put pressure on demand as well and impact their Europe revenues. So the numbers on the screen are the percentage of exports to Europe as a percentage of the total exports. Anupam Rasayan has 46% of total exports to Europe, which is followed by Vinity Organics. There is Naveen Fluorine, which has 60% exports to Europe out of the total export revenue. PI Industries at 10%, Neogen at 27%. Of the total exports to Europe. So many companies have sizable exposure to Europe as well, making them vulnerable to demand and added woes of currency depreciation there as well. Now, important to note that every company has its own hedging mechanism in place, so the net effect on earnings depends on that. But these are just some numbers that we wanted to focus on for you.
Okay, Sonal, thanks very much for that. We're going to take a very quick break now, but as we do that, here's some great news for investors. If you want to track the US market action, you can do so in real time. All you have to do is log on to Money Control website or app and stay informed about all that matters in the...
Welcome back. On the sidelines of the Forbes India Tycoons of Tomorrow event, our colleague Nisha Podar caught up with some corporate leaders and emerging entrepreneurs and started by asking them about their entrepreneurship journey and all the challenges and opportunities that came along with it. Listen in to excerpts of her chats with Astral Pipes VP, care of engineer, Eruditus founder Ashwin Damera, and Commerce Ziffy founder and CEO Sudhakar Adapa.
As a first-generation entrepreneur, everything that you're doing rides on that one company, right? So let me give an example. If you're Bhavish Agarwal and you started Ola Electric, and your first product catches fire. You may also be Tata Motors with the Nano, which also catches fire. But one of those founders' ass is literally on fire. Because if that company goes down, that's entire legacy, entire hard work. They're investors you depend on. You don't have a conglomerate to draw cash on, etc. So I do believe that you are more hungry. It's riskier. It's kind of like an immigrant in a country, right? You have to make it work.
A lot of people envy the second and third generation family business owners, but I'm sure it also comes with great expectations.
So most people think second generation, third generation entrepreneurs as spoiled brats, like, you know, born in money, free to do whatever they want. They don't have anyone to hold them accountable for, but that's not the case. I categorize second generation entrepreneurs as there are two types of them. One is you are born into money. You've been raised with people around you, with, you know, servants, maids. Then you have a second generation which basically sees their parents slog it out and sees the ups and downs of their parents as they build their empire. And, you know, I call them generation 1.5 because most of the times they value the efforts that their parents have put into the business,
right,
and have seen their parents struggle, often have grown up without one of the parents around.
Yes.
Because they're very busy building their business. They already have a lot going on in their life. So it's very different, depends on what kind of a second generation you are.
So Sudhakar, you know, a lot of people think that the family business owners have a launch pad already ready, right? But I'm sure that there are a lot of good aspects or benefits of having your own freedom when you are a founder of your own company.
Well, you know, my shoe size fits me just fine. I don't have a large shoes to fill. If you're a second-generation entrepreneur, you have large shoes to fill in all probability. Otherwise, you don't even call it a second generation because the first generation would have failed, right? Yeah. So in that sense, it weighs slightly on your shoulders. You don't have a legacy to live upon, so you are free to fall, get up, and then get again running. You don't have legacy issues, as you call it. So I would say it is what I call a founder's freedom, the freedom to experiment, the freedom not being afraid to fail, not having to live up to the expectations of people around you. That is, I think, is the advantage of first-generation entrepreneurs.
Okay. With that, we're going to wind up on Trading Hour. Thanks very much for watching. For now, we leave you with some important market opinion coming in from Ed Yardini. Thanks for watching.
I think it's a relief rally. I'm not particularly bearish. I think the market's going to go sideways with a lot of volatility. We're still going to have the Federal Reserve raising the Fed funds rate at their November meeting. That'll be early November. So in about a month, we're probably going to get another 75 basis point increase in the Fed funds rate. But a lot can happen in 1 month, as we just saw in September. And it does feel as though September was the worst month. It was a bad month historically. And October sometimes does better, especially if September created some buying opportunities. So I think the worst is over in terms of the downside, but I don't see a tremendous amount of upside anytime soon. I think we need to get to a point where the Fed clearly is done tightening. When the Fed changes its opinion, that's a pivot, but it sometimes can be based on data that they didn't expect to go the way it went. What we saw is in July, the Fed was still talking about possibly pausing in September or November. And in August, they were suddenly talking about just raising interest rates as far as necessary to bring inflation down. So that was a pretty hawkish pivot. And I think the next pivot that the markets are expecting is a more dovish pivot, or let's call it a less hawkish pivot based on an economy that's slowing down with inflation continuing to moderate. The way I see it is the U.S., among developed countries, the U.S. is widely viewed as a safe haven, which is why the dollar has been so strong and why money has actually come into the United States. So I think on a relative basis, the U.S. stock market and bond market will probably do better than some of the stock and bond markets in the other developed countries. Among emerging economies, India stands out as doing particularly well because China's got all sorts of problems, and the strong dollar tends to be bad news for emerging markets that have borrowed a lot in dollars, which doesn't seem to be the case for India. So India stands out among emerging economies, and the U.S. stands out among developed economies. At least on a relative basis, India looks very good. So not only does India look good in absolute terms, but compared to some of the problems that other emerging markets are having, a lot of emerging economies are very dependent on selling commodities around the world. And because of the strong dollar and the slowing global economy, commodity prices have been coming down. We also know that companies like Apple are moving towards India and away from China. And again, that benefits investors who are looking at putting their money in India rather than China. So again, in absolute terms and also in relative terms, India looks good among emerging economies.